Hey yo, what is going on with the viewers of the tube? My name is Tyler and hope every time this channel comes on you get a grin that goes from ear to ear, kind of like this little pooch.
Thomas, what are you doing? Thomas! Hey buddy, what are you doing? Oh my God.
You know how we denture. It's time for Chico Crypto. I said salute your shorts on Monday. Pulling out the stock market leading indicator, the Dow over the past 5 days, a severely manipulated market with volatility reaching crypto market levels. The week started out with a dump, then on Tuesday a 3% pump, then yesterday a 3% dump. And pulling out Bitcoin's chart, such similar movements. Although, because crypto never sleeps, it dumped on Sunday instead of Monday. We rebounded and by Tuesday we were looking semi-bullish. But by yesterday, midweek, down with the stock market we go. So why in the hell aren't we going up in both markets when liquidity just flooded the markets from government stimuli and QE forever? Well, as I've been saying, they're doing it all wrong, catering to the 1%, the elite and rich, when it's the bottom 99% that need it the most. You don't fix an economy from the top down, it's fixed from the down up. So let's begin with us regular citizens, what we are getting here in the United States, a $1,200 stimulus direct deposit or mailed check. Well, supposedly the direct deposits are hitting banks. Slowly but surely, we are seeing on social media people receiving these deposits. And finally, some of the indebted tax slaves get their peanuts to tide them over. But did you do direct deposit or did you have your check mailed to you for your last tax return? Because that could have some serious implications. So let's begin with that direct deposit. So some of you, especially on the social media, you got yours. Or did your bank? Yes, that stimulus check isn't first to be used for food, rent, or the necessities. Banks get the first grab at the direct deposit money if the customer of theirs has any debt or delinquent fees. And this news was leaked by Rhonda Kent, Chief Disbursing Officer at the Treasury's Department Bureau of the Fiscal Service, when she was talking with bankers on a webinar last Friday. Let's listen in.
Second, because EITs are tax credits payable under the Internal Revenue Code, they are not protected by law from garnishment, and there is nothing in the CARES Act that exempts them from garnishment. So we do understand that concerns have been raised about this legal requirement, but it is the legal requirement at this time. Another question that came up this morning related to debt collection was whether banks, whether these payments could be subject to collection from the bank to which the money is deposited if the payee owes an outstanding loan or other payment to the bank. And what I'll say here is I would suggest that the bank personnel consult with their legal offices. There's nothing in the law that precludes that action. But again, I don't know what different banks are doing with respect to their debt collection policies. I do know many creditors are suspending debt collection activity, but you will want to know for your bank what your bank has decided to do. But there's nothing in the law that precludes that action.
So your bank can seize that payment from you to keep their operations afloat, not you afloat. This is disgusting, it's un-American, and it's sad. But what about the check? No middleman bank if you use the old snail mail way. But by this method, you may have to wait up to 6 months to receive the stimulus. And if you know what is going on with our United States Postal Service, USPS, we might not have a way to mail you your check by the time they are ready. Earlier in the week, news quietly dropped that USPS said they would become insolvent if they weren't included in the stimulus bill grants. In a digital briefing before the House Oversight Committee last week, Postmaster General Megan Brennan told lawmakers that the agency would run out of cash by the end of fiscal year in September without help from Congress and the administration. Yeah, they're pleading because they had a $13 billion grant for them blocked in the $2.2 trillion stimulus bill. And Trumper, he doesn't want to bail out USPS. Let's hear what he had to say about not funding them and being accused of their demise.
My second question from a colleague is, Congressman Jerry Connolly, a Democrat from Northern Virginia, told the local DC CBS station that you personally requested the CARES Act stimulus bill be stripped of $25 billion for the Postal Service. Connolly claims that unless the USPS gets that $25 billion, the agency will be run out of money by June. He accuses you of hastening the demise of the Postal Service. Could you respond to that, please?
I'm the reason the Postal Service has lost billions of dollars every year for many, many years. I'm the demise. This is the new one. I'm now the demise of the Postal Service. I'll tell you who's the demise of the Postal Service are these internet companies that give their stuff to the Postal Service, packages, and I don't know why they're not, I don't run the Postal Service. You have a group of people, so-called independent people, and they run it. But these packages are, they lose money every time they deliver a package for Amazon or these other internet companies, these other companies that deliver. They drop everything in the post office. They say, you deliver it. And if they'd raise the prices by actually a lot, then you'd find out that the post office could make money or break even. But they don't do that. And I'm trying to figure out why. These are independent boards. They were appointed by other administrations. They're sort of long-term. They're there for a long time. And I've been talking to them also. You can look it up. Take a look. They have to raise the prices to these companies that walk in and drop thousands of packages on the floor of the post office and say, deliver it. And they make money, but the post office gets killed. Okay, so they ought to do that, and we're looking into it, and we've been pushing them now for over a year.
So some people think I'm a pure Trump hater, but he is not completely wrong here. Giants like Amazon have taken advantage of USPS, and that needs to be looked into. But Trump, come on, man. Yes, it's true the Postal Service is run by an independent board of governors, but those governors were appointed by you. Robert M. Duncan was appointed to the Postal Service Board of Governors by President Donald Trump and was confirmed by the Senate in August 2018. David C. Williams, appointed to the Postal Service Board of Governors by President Donald Trump, was confirmed by the Senate in August of 2018. Ron Bloom, appointed by Trump, confirmed August 20th, 2019. John Barger, appointed Donald Trump, confirmed August 1st, 2019. And the same goes for Roman Martinez. But what about Trump's major bugaboo, the rates of the Postal Service? They're not charging enough, right? Well, the Postal Regulatory Commission is the one who has the power to do this. Well, 3 out of the 5 member leaders are appointed by Trump. Michael, appointed by Trump, Ann Fisher, appointed by Trump, and Ashley Poling, appointed by Trump. So what is going on? Well, if things go the Donald way, it will be the end of the USPS and the beginning of enterprises taking over the postal system. Private entities, they are already saddling up, and the public good of the Postal Service will be an afterthought of the path to an America run by corporations. And the more you look into what this current administration is doing for the corporate world, while disregarding serving the public, you get we are on the edge of a collapse. But before we slide to the edge, it's time for a sponsored segment of this video, being supported by our friends over at Energi. And like always, the full details of our agreement can be found in the description. So Energi, if you haven't heard of them, they are a platform who took a different model than most. No ICO, as they airdrop their tokens to the community with one of the most generous airdrops thus far in crypto history, called an earn drop. They also took a unique model to support ecosystem development. Energi employed one of the most powerful treasury models in the space, where the funds are dispersed, allocated, and voted on in a decentralized manner. And 3 out of the 4 past tracked months, Energi has had a bigger treasury budget than even Dash, which is amazing because Energi has 1/11th the market cap of that crypto project. But we have learned about all this before. Now it's time to dive into the biggest update for Energi so far, the launch of Energi Gen 3, which happened on March 10th. If you didn't know, Energi has evolved since its birth in the summer of 2017, when it started out as a fork of Dash and ran off of proof of work. In April of 2019, Energi began their blockchain migration, switching to a proof of stake chain, which laid the ground floor for Generation 3. So what does Gen 3 bring to the table? Well, it brings something which I believe is a smart target move: the entire basket of Ethereum smart contracts. Energi is already a functioning proof-of-stake blockchain, and now it has the smart contract capabilities of the Ethereum virtual machine. Plus, it has all the previous capabilities of Generation 2, which set it apart to begin with: on-chain governance, that self-funding treasury, plus their masternode model, defense and community support capabilities. And that migration to Gen 3? Easy peasy lemon squeezy. There is no deadline for the migration of coins, there is no handing over of private keys, and there is no sending your Energi anywhere. They always stay with you throughout the entire migration process. And I have included a link with the simple migration instructions in the description if you haven't done so yet. So with the smart contract capabilities, you gotta know the dApps are coming, right? Well, that is true. My Energi wallet is launched, which is similar to my Ether wallet or my crypto, a web portal for wallet interaction. And another dApp, Energi Nexus, the web portal for all things Energi, the wallet, migration, masternode staking with treasury and Energi defense coming soon. But the stronger the developer community, the stronger the dApps, right? Well, that is correct, and due to their treasury, they have built a strong contributing community. They have over 70 developer contributors now working on the codebase or dApps, so it's only a matter of time before the first wave of community dApps launch. And this will be accelerated by the Energi Incubator program, which will focus on migrating existing dApps like from Ethereum to Energi and advancing early stage blockchain project development on their platform. These projects will have integral economic and business support from the Energi core team, including engineering support, identifying security issues, and smart contract auditing services. So catering to developers and early stage projects, it's a solid move, but Generation 3 also caters to the community with updates to their master nodes. In Gen 2, you needed 10,000 Energi to be a master node, a lot of coins, which gave you the benefit of validating transactions across a network, which meant more revenue. Going to masternode online stats, ROI is currently over 44% for a masternode. But those rewards were just one piece of the masternode benefits. You were also able to participate in on-chain governance, voting, and the allocation of treasury funds. Well, with Generation 3, that collateral requirement for masternodes has been lowered to 1,000 Energi, a whole hell of a lot more affordable, which means more nodes, more votes, and more decentralization. And it has begun and will only accelerate with time. Now back to the edge of this thing we call the American economy. Like I was saying, Trump and his administration are catering to the top 1% like never before, and they cannot hide their disgusting moves in the face of the American people. So remember the $2.2 trillion stimulus bill? Well, there is a thing in it called the Paycheck Protection Program, the PP.
This is my PP.
So this program was meant to help the small businesses of America, as it's from the U.S. Small Business Administration and their loan program. $350 billion has been allocated, and since early April, businesses have been applying. Guess who is getting their applications in first? Hedge funds are, and guess what? These loans are served on a first-come, first-served basis. And since early April, law firms have hosted webinars, and accounting firms have reached out to their clients, all with the goal of explaining how their company might be able to tap into the PPP. These companies, these hedge funds, can navigate all the legal red tape first, and they have, while restaurants, mom and pop shops, and local businesses don't even know what to do yet. This article tells it like it is. Facing extinction level event, small businesses urge Congress to replace disastrous loan program with direct payroll grants. So literally, that original $350 billion stimulus was already sucked dry by large enterprises trading stonks, equities, and foreign investments. Why do you think they already need to expand the program? Last week, Mnuchin, Snoochin, Boochin,
Snoochie boochies.
asked Congress to swiftly add an additional $250 billion to the program, which is luckily being held up as we need frickin' oversight on where this money is going. But it gets even worse, my friends, because the government, specifically the Treasury, was part of that stimulus. And I've explained this before, the Treasury's Exchange Stabilization Fund, the $500 billion replenishment of it, and the creation of the newest Fed Special Purpose Vehicles, SPVs. If you're interested in that content is included in the description as it's a good primer. But there are more details coming out regarding the SPVs and what the Fed is doing in collaboration with the Treasury. So first, it was announced that the Fed would be able to buy junk bonds for the very first time in history, which people thought, okay, not so bad. Some companies like Macy's and Ford will be moved into the junk category. It's okay for the Fed to stimulate them as to save jobs. Well, are they going to do that? No, they're buying high-yield corporate debt ETFs. Cause guess who is managing the Fed's corporate credit facility assets? BlackRock Inc. And guess who has the largest high-yield ETF out there? BlackRock, through their iShares iBoxx high-yield corporate bond ETF. So this ETF will be getting money, I guarantee it. As on April 9th, the ETF had roughly 1/3 of its assets in single B-rated debt and 11.3% in securities rated CCC or CC. Does that sound like crucial American firms who should be getting bailouts? Well, it's a dark and dangerous world right now, and I wish I could tell you what is going to happen in the short term for both types of assets, traditional and not. But you know my thoughts in the long term. Viva la crypto. Cheers, I'll see you next time.